Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's May 8th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. What a week. This Mueller report, no idea how this continues to make headlines. I mean, just think about it, right? If the Democrats fought this hard during an election, I think Hillary would have won a landslide. It's insane. Just keep going to it and going to it. I mean, surprise is such a big deal considering everyone outside of the Democratic Party have moved on for this, and including people on the fence who are not Republicans or Democrats are kind of, and you know, that's where the Democrats need to target to have any chance of beating Trump in 2020. And the Mueller report, you keep going on and going on and going on. I can't believe it's still going on. You know, just it's always in the news. It's just surprising. This week, you also had Donald Trump awarding the Medal of Freedom award to Tiger Woods. And this should have been a great event, a nice, happy event, right? This is cool. And I love, you know, listen, Tiger Woods, I love people who come back, and not just come back and winning. I'm talking about, you know, the tabloids and cheating on his wife and taking the drugs, the DWI and lying. You know, listen, tabloids destroyed him. He lost sponsors. You know, he paid for it. And then, you know, he came back, and it makes you a better person. Look, we all go through ups and downs in life. All of us. We're all going to make mistakes and stuff like that. But just like the American way, it's like coming back, saying, hey, you know, just like Hillary. If Hillary just admitted, say, listen, I didn't fight as hard. I didn't fight as hard against Trump. And she didn't. The facts show she wasn't in enough states, right? She wasn't campaigning even in the right areas. She wasn't drawing much attention, especially in the past, you know, the last 90 days of that election. And she ended up losing, and she got killed. And that's okay. But if she came back and said, listen, I didn't fight hard enough, but you know what? This time it's going to be different. People love that. They love that. Instead of complaining, Mueller, Russia, that's why I lost. Oh, my God, it's just crazy. With Tiger Woods, you know, should have been like a pretty cool event. And I just love how the left just can't say anything nice. You know, they got to involve Trump in this, right? No matter what. I mean, some of the headlines are hysterical. One from the Undefeated. They say, tearful Tiger gets honor of a lifetime from a controversial president. Or the one from MSNBC. Guy who drives a cart all over the green gives Tiger Woods an award. You can't just be nice a little bit. CNN. There's somebody on CNN. Let's not make it more than it was. It was all about golf and Trump attaching himself to Tiger Woods. Even in a good time, a good event, right? That should have been just a positive all around. You still found ways to just, you know, throw Trump under the bus. I guess that's more important. Just don't get it. I mean, you're allowed to say positive things sometimes, even about people you hate. But trying to spin a great story into a negative is a reason why, you know, so many Americans, especially today, right? I think most politicians are assholes, and the media producing this garbage is useless. But hey, we know the deal. It's getting clicks from your supporters, your base, and that means more money in your pocket. And we all know that's the only thing you care about, even though technically as a news provider on both sides, your job is to report the news in an objective and fair way. You're supposed to. We know it never ever happens now. And this goes into my point, because speaking of the media, they're all over this tariff news, all over it. After Trump, this is on Sunday, threatened to impose tariffs on almost all goods imported from China. He says he's going to do this on Friday, which is kind of a surprise, right? We were told by Trump, Colo, newest people in his cabinet, that talks are going well. If China's top delegates flying in this week to discuss trade with Trump, a deal's supposed to get signed, and get pretty close to getting signed. Then on Monday, the markets fell sharply after Trump tweeted and said, hey, you know what? We're going to raise tariffs. We don't like what they say. We said there's a Reuters report out there saying that, you know, basically China switched a whole bunch of things in the agreement. It's going back, whatever it is. But you're looking at this uncertainty, right? And what happened where, you know, on Monday, the markets fell sharply, then recovered almost all its losses. But then you look on Tuesday, the markets fell again, nearly 500 points or close to 2%. This time they didn't recover like they did on Monday. You know, today they're holding their own. Now, look, I love what Trump's doing here. And remember, it's in his best interest to keep the economy strong, the stock market higher, That's why he's always criticizing the Fed on Twitter at least once a week to try to influence them to lower rates next year, right? People invest in their wallets. If the economy market's good, it's almost a guarantee he's going to win the next election, right? If it falls, he's going to be in trouble. So why would Trump shake things up like this, knowing that this news would definitely create uncertainty and push the markets lower? Because there is zero chance, that China does not sign a deal with us. Unless they want their economy to fall into a depression, which it basically did in 2018 while most of this nonsense between the U.S. and China and raising tariffs was going on. I mean, if you look at China, it's the growth engine of the world. But when you really dig down to the numbers, we're the largest consumer of their goods, accounting for 20% of China's total exports. Hong Kong is second with 12%. But if you look past Hong Kong, the next 5 trading partners with China, if you combine those amounts, account for roughly the same amount of exports China sends to the U.S. Again, this is based on sales. That's how big of a component we are to them. Now, when it comes to the U.S., look, we have the greatest economy on earth, which I kind of wish most of our population understood a little bit more, since some countries don't have access to water or doctors, and we take stuff like that for granted. That's another rant. But our consumers, businesses, we've been conditioned at birth to spend money. Regardless, forget about your politics here. Say, well, that's why. Don't forget about it. We've been conditioned to spend money. That's what we do as Americans. That's what we do. So spending and spending and spending. You think about that. We have the richest consumers in the world. It's great for any country, any business that's outside of the U.S. and even in the U.S., of course, just looking to sell us products. I mean, you need exposure to the U.S. It makes sense, especially if you're another country outside the U.S. And when you look at this deal, it's so much more important for China than it is to us. It's not an opinion, guys. It's fact. I mean, you want proof. Look at the headlines once it's released on Sunday. Our markets since then are down less than 2%. Two trading days. China's market crashed by 6%. They're down 6%. 6% alone on Monday. Came back a tiny bit, but it's still down 6%. But that Monday decline alone, it was the largest decline in 3 years. The daily decline. But Trump is in a position to play hardball to make sure that China gets the message that we want this deal done ASAP, so don't mess around. I mean, here's a good example. I mean, China playing hardball with us is like companies like Skyworks, ST Microelectronics, Analog Devices, right? These are big suppliers to Apple. It's like threatening Apple, their largest customer. I know Skyworks, ST Micro, Analog Devices, respectable companies, market caps between $15 billion and $40 billion. But Apple is a behemoth, $1 trillion market cap. It has 5 to 10 times more cash on its balance sheet than what these companies are actually worth based on market cap. I mean, Apple could essentially buy these 3 companies at the same time tomorrow and barely see a dent in its balance sheet. So China playing hardball with the U.S. is like one of these suppliers threatening Apple if the tech giant doesn't comply with their terms. That's where we are right now. And look, China has to do this. I get it. They have to save face. They don't want to get bullied here. They want to stand up to it. I get it. It's fine. That's the game they have to play. But as an investor, you, mom and pop, and I said this through 2018 and received a lot of negative emails, which is cool. I'm going to say it again right now. This tariff thing is a non-story. It's a deal that will happen. Too much is at stake for China. And China has plenty of things to offer us behind closed door to make this deal happen, as they use a shitload of natural gas, which we have basically an unlimited supply of. So much that we burn it just to get rid of it. And now we're going to see a ton of LNG export facilities open up over the next 5-10 years. We only have 2 operational who just seeing demand through the roof. Sabine Pass for Cheniere Energy, Cove Point for Dominion Energy. Those are the 2. Originally import facilities, and then Shell Revolution, Shell Boom, now they're export facilities. And now you see dozens more going to open up over the next 5 years. Aircraft, soybeans, cars, our biggest exports into China. Something could be worked out behind closed doors. There's a lot. Or have China provide incentives for our companies to build factories in China. I know, everything wants to be built in the U.S., but at the end of the day, China used to be the end all of manufacturing, right? Low labor costs. Lately, they've been losing market share to other countries that are providing even cheaper labor. And that's not a bad reflection on China. It just means that their economy is starting to grow a lot more. But seriously, guys, I mean, tariffs are not the crazy long-term risk that's going to put both our economies into recession and spark this massive trade war. I know that sounds crazy with the media telling you that the world's going to end, just like they did through 2018, citing trade wars and recession. And if you look at the details, the S&P 500, it fell around 6% on the year, but most of that decline, which was a 20% decline, which is amazing, from September through December, had to do with the Fed, right? With the Fed saying, hey, we're going to raise rates, pedal to the metal, we're going to raise rates. And then finally they switched, and now you're looking this year, we're doing very, very well. But apples to apples comparison, let's use a 6% decline that we had, right, from last year in the S&P 500. China's market, Shanghai, fell 24% last year. The worst performance in a decade. And this year, right, if you look from January to mid-April, pretty much this time period where the U.S. and China trade fears was off, it eased. Everyone's like, okay, deal's going to get done. The Shanghai index surged 30%, right? This incredible rebound because this risk, the uncertainty was off the table. We think a deal's going to get done. That's almost twice the gain of the S&P 500 over the same time frame. My point, the people who are telling you that a U.S.-China trade war is worse for the U.S. than China are either complete idiots, since they don't know how to analyze data, or they have an agenda. If you still think I'm crazy, let's dig in a little bit, since, I am an analyst. Let's go to the math. And let's use the auto industry as an example, who uses a ton of steel to produce cars. If you're looking at one car, and really quick, guys, going to be numbers here. You don't have to memorize every number. You're going to see the point. I'm going to go through this quick. So you have one car uses an average of 2,000 pounds of steel. 50 cents per pound, let's say, that equals $1,000 per car. So a 25% bump in steel prices for U.S. producers would amount to $250 in extra cost to produce a car. Now, the average profit margin for cars is about $4,000. So the 25% increase in tariffs on steel works out to a little bit more than the 6% hit on margins, which is no small potatoes for the auto industry or any industry. A 6%, that's pretty big in margins. That's why usually when people talk about margins, it's basis points, because usually a little higher, a little lower. 6% is a big deal. But last year, we slashed the corporate tax rate from 35% to 21%. It's a pretty big deal when you look at the numbers. Remember, gross margin per car, $4,000. So instead of paying 35% in tax on these profits, which amounts to $1,400 per car companies have to pay 21%, which amounts to $840. You can write down the numbers if you want. If not, I'm getting to my point. I hate throwing a lot of numbers because I don't want to lose you. This is important. Because if you subtract what they used to pay when it was a 35% tax rate compared to today and a 21% tax rate, you're looking at the automakers making an extra $560 in added profit per car just due to the tax reforms. So it's $560 that you're making because of tax reforms, and take the $250 off of the 25% increase in tariffs. That means car companies are still making an extra $300 plus in profit per car when they factor in everything, right? Higher tariffs and tax reforms. Bringing it all together. Sorry to throw so many numbers at you, but it's important to understand this because nobody's talking about this. At the end of the day, car companies are still making an extra $300 plus on every car they produce, which increases the profit margins by an incredible 7%, even if we have 25% taxes on some of this stuff. That's why earnings last year, through all this tariff nonsense, double digits, fastest pace in years, despite all the tariff nonsense, right, through 2018. Even though the trade war was supposed to crush our economy, it was supposed to end the world, save yourself, build a bunker, buy guns and shoot the rioting people that are going to crash into your home and raid your home and steal everything. You got to worry, holy cow. And let me tell you something else. The companies that said they were impacted by high tariffs last year, like Harley-Davidson and Whirlpool, were lying out their ass. They missed earnings because demand was crap for motorcycles and new appliances. Their management teams were just not getting it done. They didn't see that lower demand curve. They didn't adjust for it and find things to adapt. It wasn't because of tariffs. Not after those tax reforms, which is huge. So look, you could believe whatever you want to believe. It's totally fine. Some of this stuff is a religion to people, meaning no matter how many facts I throw at you, it's not going to matter. You're never going to change your mind, and that's okay. But for me, right, the reason why you listen to this podcast, I think I'm someone here to help you avoid all the BS stories in the media or the crap being published by investment firms, news that are published. Most of these people have an agenda. But I'm telling you, trade wars, tariffs with China, it's a non-factor. It's not a long-term risk. You should look at it as the Zika virus, where the media scared the shit out of everyone, right? So much so that our greatest athletes chose not to represent their countries in fear they would contract the virus by going to Brazil. Remember that? Remember that story? A lot of famous golfers, too. I remember. I think Rory McIlroy didn't go to a couple of this whole scare, putting that fear into you, right? Who's talking about Zika today? I don't know. The mosquitoes just suddenly stop biting people? I mean, talking about a virus that if you contract it, the symptoms are so mild, you don't even know you have it. And there were rumors suggesting that if you contract this virus, especially when you're pregnant, for women, your baby could develop a birth defect, even though there's no hard evidence at all to support this. Zero independent, non-biased studies to support this. But because of that fear in the media, you actually think about that 10 years from now, 20 years from now, 30 years from now, when guys like Rory McIlroy have grandchildren, and you had the opportunity to maybe you're going to have an opportunity to do it later on, maybe fine. But some people don't, especially in different sports where age matters. You can play golf for 20 years. Tiger was 43, just won. He won his first, under 20, whatever, how old he was. But if you're looking at different sports, I mean, sometimes it's an 8-year window before, you tail off a lot. It's hard to compete with younger athletes. But think about telling your grandchildren, I had a chance to represent my country, and I didn't because I was afraid of the Zika virus. What is Zika virus? Well, it's nothing. That's what the media is all about. Anyway, don't get caught up with the media bullshit, especially when it comes to tariffs. Like I said in 2018, the same goes for today. You should be buying stocks on any weakness due to tariffs, especially this nonsense going on right now. It's a short-term political story, not a long-term risk that's going to impact your portfolio. So adjust accordingly. Moving on. Rant ended. Great interview today. One of your favorite guests was John Petrides, Managing Director, Portfolio Manager at Point View Asset Management. Over 20 years experience, great stock analyst, a regular on my podcast, someone I love having on since we can go anywhere with this interview, including tariffs. We're going to talk about earnings, the economy. More important, which I know you guys love, is John always gives a lot of stock picks. He's going to give probably at least 5 to 7 ideas, new ideas, which is great. So I know I get so many positive responses, so many positive feedback from me at frankcurzioresearch.com. Keep it coming in. I love that. This podcast is about you, not about me. But when John's on, guys like Andrew Horowitz are on, guys that could talk about the market in general and so many different topics, we usually get the best responses for it. And this interview is not going to let you down. It's going to be fantastic. It's coming up in a minute. Then in my educational segment, I want you to do me a favor. This is important, since I rarely ask you for anything. Get away from the spouse. Get away from the kids. Go to a quiet place you love for about 20 minutes. That could be the bathroom for most males. Whatever. Find a nice, quiet area. And please pay close attention to this segment. I promise it's going to be one of the greatest lessons you'll ever learn about investing. As I will break down one of the mistakes I made. Yes, I'm going to talk about mistakes, right? Never said, don't ever talk about your mistakes. Always talk about putting. No. You learn the most from your mistakes. And this mistake was one where I answered a question on my Frankie Speaking podcast. It was a great question. I gave a great answer, one that I would give again based on my experience. But I happen to be wrong. I'm going to show you how this mistake will lead you to becoming an incredible long-term investor. To the point that you're going to know more than most experts who follow the markets on a daily basis. And I'm not kidding. You're not going to find this lesson in any books. You're not going to hear anybody talk about it on TV, in the media, or anywhere else. But it's something that's going to help you become a fantastic investor. And when you hear about it, the funny thing is, you're like, wow, that really makes a lot of sense. And it does. So trust me, just need 20 minutes of your time. I'm not building this up. I'm not teasing it. I'm being dead serious. It's really cool. I'm going to highlight one of my mistakes that I made, and you're going to see why learning from this mistake, and it's just this mistake, but I'm going to put it in a bigger concept, is going to lead you to becoming a much better investor. Now, before I get to that segment, here's my interview with John Petrides. John Petrides, what's going on?
Hey, Frank. How's it going?
I see you're kind of busy these days, all over the media, a lot of demand for you. And I say this to a lot of my guests where don't forget about us little guys when you get really big and you start doing fast money and everything. Remember guys like us, hopefully you still come on the podcast, but how are things going?
It's going well. It's busy. Obviously it's been a nice market to ride the wave, I guess, year to date, because volatility up until a couple of days ago has been relatively calm. It's been quiet. Reminds me almost of 2017, where the S&P 500 finished positive at the end of every month for the entire year, and there was essentially no volatility. So from that standpoint, it's been a really nice market.
Now, today, we'll go over this week, right? Tariffs are the big story now, and I've argued in my opening pretty much that it's kind of a non-issue in terms of being a long-term risk or, an outright trade war between China and the U.S., and told everyone in my opening segment to buy the dips because a deal has to get done unless, China wants to push its economy into a depression. So it's eventually going to get done. But I want to get your thoughts on tariffs real quick because, also you've been telling clients to buy dips as well. However, there was two other reasons why you said that people or investors should be buying. So I want to talk about tariffs a little bit, and also those other two reasons why you've been saying, hey, you know what, you should be buying the dips because of these two reasons.
Yeah. So clearly, what investors should never do is trade on your portfolio, buy or sell, based on rumors. Frank, Top Gun was one of the great movies of all time in the 1980s, and one thing that Maverick always said was he's not leaving his wingman, because when he left his wingman, he got shot down, and he held to that at the end, and obviously the good guys won. Here, when the market gets volatile, you can't leave your wingman. You have to stay disciplined and consistent to your investment process. So on days like we've had over the past couple, when the president tweeted out that he's threatening to increase tariffs on China, the market in general sold off. Now, admittedly, the market has had a strong run year to date, so taking a deep breath is not necessarily a bad thing. But because of what the potential outcome of tariffs may or may not be, should not influence you if you like the company and you think the cash flow and the business model is strong enough to weather this type of storm. So, we are not buying or selling the rumors based on a trade deal. At the end of the day, it is in the Chinese economy's best interest to get something done. Now, you're dealing with a lot of unorthodox personalities on the U.S. side and on the Chinese side, which makes this a bit more difficult to wrap a probability about expectations. But I think, as we can all see from the impact that tariffs have had on the Chinese economy, it's in their best interest to get this resolved.
Now, talk about the other two reasons why you've been saying, and you've been saying this for a while now. I mean, it was, you talk about lower yields. You look at a Fed policy where the Fed actually changes tune completely not too long ago, where that really pushed the markets down from September through December, where the Fed was like, hey, we're going to raise rates, and they said all of a sudden, like, hey, we're not going to raise rates, and actually we may lower them depending. We're going to look at the data now. So when you look at that and these favorable, conditions, these macro conditions, you're still suggesting, hey, you know what, buy these dips?
Definitely. I mean, we were buying in the fourth quarter of 2018. We continue to buy here today. And we thought that, I think much like yourself, that the fears of the U.S. heading into recession and the global economy heading into recession was really misplaced. We think the market just priced in way too negative of a scenario. So you've seen two legs of this rally take place. The first one was actually three legs of the rally take place. The first one was that the macro data and the earnings data came in better than what expectations were, which was for recession. And we're not seeing any signs flash anywhere, particularly within the U.S., of the economy heading into recession. And earnings have been quite strong off of what was a very difficult year comp-wise year over year, given last year we had the tax cuts, right? So that set off the first wave of, okay, we're not heading into Armageddon. The second wave was the Fed, particularly in March. Fed Chair Powell said, the U.S. economy looks good, and the Fed will do everything in its power to keep it that way. Frank, that was it. Game, set, match on that quote right there, because it basically puts the safety net back into the market, which has helped really drive stocks higher post the financial crisis. That if we do head into a bumpy patch, if trade tariffs do increase and Trump does levy a higher tax rate on the Chinese, and the Chinese economy does fall into recession, and the global economy does slow, what are the central bank and global central banks going to do? They're going to print more money. And when you print more money, it forces bond yields down, it makes cash less attractive, and it forces investors out the risk curve to invest in stocks, and that will push stocks higher. So the first leg of the stool was that we are not heading into recession. It was a big, deep sigh of relief. The second leg of the stool has been that the Fed has stepped to the side and is printing more money and is staying out of the way of growth. And the third leg of the stool, and you really saw that in the month of April, was that growth stocks once again took the baton. I mean, growth was outperforming value stocks by about 5% year to date. And if you look at the NASDAQ in particular, at one point in time, it was up over 20%. If you look at the S&P 500, right, 20% of the S&P is in tech, and about 10% is in communication services, which is a new sector that owns the likes of Facebook, Google, and so on and so forth. And so if you combine those two sectors, about a third of the market is really, really strong, and that's what's pushing the S&P 500 higher, and those two sectors are predominantly growth stocks. So those have really been the three legs of the stool that have gotten us to the point where we are today. To move this market higher, I do believe that you need some resolution on trade tariffs. That would be sort of the biggest cog in the wheel at this point, without to see further growth going forward.
Now, let's get to one of those things you just mentioned, which is earnings, right? So we're coming to the close of earnings season. A lot of companies have already reported. I know you cover earnings like I do, where you're analyzing so many different stocks and also looking at the macro backdrops in terms of, total earnings growth for the S&P 500, even sectors. In this earnings season, has anything stood out to you in terms of surprises, positive and negatives? Because, I guess two things, and I'll start here, that stood out to me was one was Google. I couldn't believe how it was like a slowdown across the board, right? Where Google better put up amazing numbers next quarter because they have to justify that 25 times forward earnings multiple. This one was really weak. And another thing was Apple, where I was really surprised the stock roared higher. And yes, I know they beat consensus estimates, but those estimates were significantly lowered by analysts in the quarter. But when you're looking at the real numbers, Apple's earnings and revenues are going to declining year over year. Product margins declined. Just seemed like the numbers would have justified maybe a small pullback instead of a company trading like right through 200 and everything's great and Apple's back. I was just like, whoa, guys, take it easy. And they're not growing sales and revenue. And every other company has S&P 500. They're growing earnings are around 1-2% right now. It was supposed to be negative, but they're actually growing and growing sales more than 5%. And they had the same multiple as Apple. So those are two things that surprised me. What about you? Because I know you talked about those two subjects, but I know you also talk about tons of other things when it comes to earnings.
I want to add Amazon to that mix, and I'll explain it in a second, that I thought was actually a little surprising. On the first off, let's talk about, one of the, regardless if you own a stock or not, you have to read, or listen to their earnings calls from multiple stocks across multiple sectors, right, to put the piece of the puzzle to see where we are today, right, and where are we headed? What are different companies saying in different sectors to put all the pieces together to figure out where the future growth rate is. So I thought what you saw at Caterpillar, I thought what you saw at 3M, which had its worst trading day, by the way, since 1987 when the stock market crashed on the day they reported earnings. And so those two, and FedEx, those three companies are global in nature. They're very reliant on global growth. And what you saw out of all three was just a confirmation that the global economy is slower, and although not in recession, it's just slower than when it once was. So not that I was surprised by it, it's just confirmation of what I think the market was overly concerned about and shouldn't be as concerned. They weren't screaming recession. They were just confirming that global growth was slow. Okay, fine. The next thing were the banks. And I thought the U.S. bank earnings calls were very good. Again, confirming the fact that we're not in a recession. The loan profile of banks were really strong. Were solid. Banks are continuing to navigate in a flat yield curve environment where the shorter maturities are yielding around the same as longer dated maturities are. And the wider that spread, the more the banks make. So the fact that the banks are still able to earn out in that period is very healthy and a good sign. Now let's talk about some of the bigger cap tech stocks that you mentioned. I think the reason why we saw Apple stock rally as much as it did was twofold. One was the capital allocation decisions to shareholders, right? Buying back a ton of stock. We're in a low yield environment, so they decided to increase their dividend at a healthy, 5-6% type of clip. So investors like the fact that returning cash to shareholders. The second thing is Apple is extremely sensitive to what happens out of the Chinese economy. China is 20% of Apple sales, and they did see a rebound in China. So that was, if you remember, the first week of January, Frank, Tim Cook came out and revised guidance lower because of weaker China. I think the fact that China was growing again was a big sigh of relief for Apple investors, and those that may have been on the sideline, may have been a bear, were able to say, okay, maybe we are all systems go here. So that's what helped move Apple higher. I agree with you. I'm totally surprised, or was totally surprised by Google's results. Google had 35 consecutive quarters of growing its top line 20% or greater. That's amazing. 35 consecutive quarters. That's just unbelievable. 20% plus top line growth. Mm-hmm. So you finally saw that number come below that. And the comments coming from management were kind of confusing. They really could not pinpoint the reason of why their top line was a bit slower. Mm-hmm. So I agree with you that next earnings call, Google is going to have some explaining to do to figure out what's going on, if there is an issue within their business model. Because, frankly, incremental marketing dollar. So the next marketing dollar spent is going to either Google and or Facebook or both. So, is this something where Facebook has now become a true competitive threat to Google's model? Time will really tell. I thought, in terms of Amazon, Frank, I thought one thing that Amazon's call did not get enough attention. Amazon announced on their call that they're working on next day delivery, and that got all the buzz, in my opinion. They're going to spend money, do next day delivery, and if they're focusing on convenience, the convenience factor for the consumer is the big driver. What I didn't think get enough attention was that AWS, Amazon Web Service, I'm going to say this sort of tongue-in-cheek, only grew 41%. Now that's that business line, which is their highest margin business line. It's a pure cash cow. Had been growing between 45 and 50% for the past couple of years, year over year, every quarter. Now, why is that important? To me, AWS is the secret sauce. It's the cash cow that allows Jeff Bezos to do things like go out and buy Whole Foods. It allows Jeff Bezos to afford the ability to do next day delivery. E-commerce for Amazon is a very low margin business. Whole Foods is a very low margin business. So much like Geico for Berkshire Hathaway, where Buffett uses the float from Geico to buy all these other businesses and gets a higher return on investment, AWS is exactly the same for Amazon and Jeff Bezos. And if that starts to slow, if that dips below 40%, you're going to see the multiple on Amazon get sucked out pretty quickly, in my opinion, because that's the growth driver of the stock going forward. So I thought that didn't get enough attention, in my opinion, and fears if that does start to slow, investors need to be careful.
Yeah, no, that's a good opinion on Amazon, and even on Google. Google was just a surprise to me. It's kind of funny because we're not saying, guys, that Google's a bad company. It's an amazing company, but like you said, 30 plus quarters with 20% growth. That was the number of people were looking at with revenues, and that declined. But it was just an overall slowdown across the whole business, and it was nothing to point to other than, it's important that this company continues to grow. Not only at 20% at their size is insane, right? As you get bigger, it's much harder on a percentage basis to grow. But the fact that management was kind of arrogant on that call and not really addressing that, it was just like, whoa, take it easy. But it was, it just seemed, the company has a very, very high multiple, and you're not growing as fast as you. And it looks like that's going to stay the same going forward, where 15% growth for a large cap company is amazing. The average company's grown sales growth by 5%. But remember, the stock price of Google is reflecting that at 20% plus growth. So now that multiple has to come down. So it's not like we hate Google or it's bad. It's just the price right now is pretty expensive based on the numbers they're putting up. Again, Amazon was interesting. To add to your slow international growth theme, I don't know if you saw the numbers from Floor, which were horrible. I mean, that stock crashed 25%. Global infrastructure company adds to your thesis. And John, I think you're being really like you know me by now, and we're getting good at this because my next question was about banks, which you addressed, and we'll get more into it because it's also a sector that I love. And you mentioned net interest margins, a little bit under pressure as the Fed's in pause mode right now. And guys, just to break it down for banks, margins usually increase when the Fed raises interest rates, or at least the spread between where they borrow and lend widen. And of course, I was going to ask you this. One question is, do you get negative feedback because I still get negative feedback if I tell everyone to buy the banks. But if you look at the fundamentals, their balance sheets have never been stronger than the history of this country because of the current rules in place. So the only thing that they're allowed to do if they pass a stress test, which is every bank except for Deutsche, about 35 of them, the only thing they can do is really buy back enormous amounts of their stock and raise their dividends every year, which is going to continue for many years to come. And I saw one bank in particular. I like Citigroup, but I saw that you like Wells Fargo. Could you tell me why you like Wells Fargo out of all the major banks?
Yeah, so I guess the way to think about it is the major banks, J.P. Morgan, Bank of America, Citigroup, Goldman Sachs, and Wells Fargo. Think of those as the five largest financial institutions in the U.S., and I guess in the hierarchy, it's a four-way race between Goldman, Citi, Bank of America, and Wells Fargo. Okay, we like pretty much any and all of those three. J.P. Morgan is the one where, although it's the highest quality, and probably the strongest financial institution in the world, we think you're paying up for that fact, and we think you're paying up at current valuation to be a shareholder with Jamie Dimon. Much like for the longest time, Wells Fargo got the biggest premium of the banks because Warren Buffett was a large shareholder. And for the longest time, Wells Fargo was considered the cream of the crop. They were the best institution, right? They were the gold standard of banks. By and large, up until recently, Wells Fargo had avoided any major catastrophes. They didn't have the London whale like J.P. Morgan did in 2011, 2012. They were forced to acquire Wachovia and some of the other acquisitions in the financial crisis, right? So and they've been fairly conservative from a lending institution historically. But given the headline risk that Wells Fargo has had with some of the nefarious practices they've done with some of their client accounts, making up fictitious accounts to try and boost some of their goals and some of their achievements, a little bit of the luster has been taken off of the stock. And because of that, the valuation has come in. So, the idea with buying Wells Fargo now is on a relative basis compared to J.P. Morgan and compared to where Wells Fargo has traded historically, it's significantly more attractive than it has been in a very, very long time. So that's sort of the thesis. It's a relative game. I still think that Bank of America is really cheap. I think Citigroup is really cheap, despite the 30% pop that we saw, 25% pop we've seen in Goldman Sachs following the hedge fund scandal in Malaysia. Goldman is only trading at or around book value. So, we think the stock definitely deserves more than a premium to book value. It is Goldman Sachs. They're well diversified across the entire financial spectrum between banking, trading, wealth management. And to be honest with you, Goldman has bought about $200 billion of deposits, thereabouts. To put that in perspective, Citigroup has about $1 trillion in deposits. So Goldman is slowly moving its way toward building its way up to being a full-service bank. So that's sort of thought on the banking sector. I do think it's attractive, and I'd feel comfortable owning all four of those. J.P. Morgan is probably the one where I would wait for a better entry point.
Outside of the banks, I love you. You already shared so many ideas, and we talked about so many individual stocks, which is why people love when you come on. They just love new ideas and everything that's going on to the markets. But Is there something that hit your radar after listening to the latest earnings calls, or maybe something that changed, maybe you changed your mind on in terms of individual stocks or thing? We talked about Google, a couple of technology, and just banks right now, but is there anything else that really stuck out that you listened to a conference call or maybe changed your mind on something that you were recommending, or you said, wow, this is worth taking a look right now?
The stock that I was kicking the tires on, that I still like. Energy is one of the sectors that we still like here, despite the price of oil going up about 50% from its lows in the fourth quarter of 2018. We still think there's room to run in the energy sector. And the one stock that I really like is Kinder Morgan. Now, KMI is a ticker. Now, Frank, you and I remember from 2010 to 2014 the influx or the hype that the MLPs, the Master Limited Partnerships, got, right? Everyone wanted to own the Master Limited Partnerships. These were the oil and gas pipelines that moved, basically the midstream part of the energy sector. And the story from 2010 to 2014 was, the MLPs were like a toll road. They're highly capital intensive, but once the pipe is in the ground, and you move oil from point A to point B, you clip a toll along the way, and they should be fairly insular to the price movement of natural gas and oil. And by the way, they kick off a huge dividend, typically between 6 to 8%. And in a low yield environment, who wouldn't want that type of income stream? Well, that was the narrative for about 4 years. And then in July of 2014, the oil market collapsed, and oil went from about $115 in July of 2014 to $25 by January of 2016, and the MLP space was basically over. It was essentially retail and high net worth investors that owned MLPs. Institutions could not get into the game because of the MLP structure. They couldn't deal with K1s and tax issues and all that stuff. So, and investors in the MLP space really were burned, and they have not come back into the space. Kinder Morgan was the poster child for the MLP space. Ton of debt on its balance sheet, owned the most amount of pipeline, paid out a big dividend, grew their dividend in the face of rising capital costs, and essentially in 2015 they got caught with their pants down. They had too much leverage. The rating agencies turned their back on them, and basically that was it. They had to cut their dividend, and basically they had to hit the reset button. Well, today, Kinder Morgan is no longer an MLP. Ticker is KMI. They still own 40,000 miles worth of pipe across the country. They claim to transport 40% of the country's natural gas. They're now investment grade rated on terms of their balance sheet. They have, I think, a 4.5% dividend yield, which they plan on growing, I think, 25% over the next couple of years. They have a $6 billion backlog, of which about 60% of it is contracted out, which essentially is guaranteed. So, the stock is up. It's around a little under $20. And here is a company where I think you get good yield. I think all the negative stuff of the oil and gas pipelines is now behind us. We know the growth coming out of the shale throughout the country. That's not going away. And I do think now the leadership team of Kinder Morgan has had its big moment, and they're not going back there again. So they're being significantly more conservative in terms of their cash outlay. So KMI to me is a nice way to play the energy space and get a big fat dividend yield off of it. And again, it's no longer a master limited partnership, so you don't have to deal with K1s for your taxes.
All right, John. So now we're going to get to the most important question here, because I know that, and we covered a lot of stocks, which is great, but I know that you're a sports fan, since we always talk about fantasy football and stuff like that and everything going on. I'm not too sure if you're a basketball fan or not. Are you a basketball fan or a hockey fan?
I am unfortunately a Knicks fan.
Yes, and that's got to be, that is unfortunate. Coming from New York, yes, I know. So that's unfortunate, but enjoying the playoffs right now. I think that if a lot of people, if you're watching the NBA, it's never been so open at this stage of the playoffs where Golden State, I guess, a couple weeks ago was like the favorite, but now they just lost 2 to Houston. You have Milwaukee losing to Boston the first game, and then all of a sudden the Bucks just amazing. They're blowing people. They've just blown out Boston right now. Unbelievable. Toronto, different team, right? Because of Kawhi. And then Denver, man, everybody thought they were going to lose to San Antonio the first round. I mean, great team that moves the ball.
Yep.
I mean, who do you see winning this thing? Because, basketball fans out there, it seems like there's, 4 teams that could win this that are very good compared to, it's Golden State and back in, it's LeBron. But yeah, it's pretty open this year. Pretty cool.
So to me, it all depends. If Golden State can survive Houston, then it's Golden State's to lose. But to me, Golden State doesn't look like the previous 3 years. Steph Curry, his body language just does not look into it. There's a lot of bickering going on within Golden State that, it does look like, maybe that dynasty is starting to come to an end if they can't get past Houston. But they just look really lethargic. They just don't, they played probably 400 basketball games in the past 4 years. So, and with pretty much domination. So, If Golden State gets through it, I do think they survive, and I do think they wind up winning the championship. If Golden State does not win, if Houston beats them, I think it's Toronto's to win. I mean, they look so complete. I mean, Giannis is a beast, but he is a one-trick pony in terms of driving the – sorry, Bucks fans, but, Cleveland couldn't do it over the past couple of years with just LeBron, and Giannis just isn't there yet. He needs more – players around him to make that a true championship team, much like Jordan needed Pippen and LeBron needed Kyrie and Dwayne Wade needed LeBron and Shaq, that sort of thing. He needs that second player. So to me, I think Toronto just looks so deep and so complete that if Golden State loses, I think the Raptors finally win.
Yeah, it is interesting, too, because Toronto fans out there are like, oh, no, we always see this. But when you have a superstar like Kawhi, it's a game changer. I mean, if you see him not playing well, he influences the game so much, where if Steph Curry, his shot is off, he's done. He's one of the worst defensive players in the league. I mean, Harden blows by, everybody blows by him in 2 seconds. With Kawhi, it's just a total different outlook in defense and offense. And, it's been pretty incredible. But, yeah, if you're not watching NBA playoff, guys, I know a lot of people hate, but I mean, Portland series with Denver, you want to see 2 teams just like killing each other, playing hard. And you don't see those games because they're usually on late at night. But man, it's been pretty exciting, also in hockey as well. But I always love getting your take on sports because I know you watch sports.
I love hockey and basketball playoffs. My thought is, and it'll never happen, is that both leagues should just move down to the 20 largest cities in the country, play a 50-game series. Every team would have all the superstars on it. And basically every game, you only play 50. There's no reason to play in hockey in June. So you go to a 50-game season, 20 teams. Every team is stacked with great players, and then you let it roll in the playoffs. And I think, I wish the NBA would do the same thing. You don't need to play 85 games, whatever it is in the NBA. You go to 20 teams, play 50 games, and every team is then a super team, and you basically have a dream team throughout the league. And that to me will be a lot of fun because then every single game every night is going to be competitive. It's going to be great basketball, great hockey, but that's not going to happen.
And based on that thesis, I'm sure you love baseball.
Yeah, exactly.
A million games, yeah. So, all right, John, we covered a lot today. I know people, I say this a few times, this podcast alone, people love when you come on because, we can always talk about things that are relevant in the market. It's timely. You're always giving ideas and stuff like that. And with this particular podcast, guys, John decided to come on. We just had a late cancellation, and which happens sometimes, really, really great person, but who's going to be on, I think, next week or the week after. And you actually filled in very, very quickly for me, and I know how busy your schedule is. So I just want to say thank you. I know, my listeners really appreciate me to come on. So
no worries, Frank. I always love doing the show, and I always love catching up and chatting. So it's my pleasure.
Great stuff, and we'll definitely talk soon.
All right, bud.
Okay, guys, great stuff from John. Man, I love having him on. He's getting quite popular. I wasn't kidding when I said at the beginning of that interview that he's all over the media networks, getting a lot of attention. He's got charisma, and plus he's brilliant. So, on TV and media, it comes across great. Even on the podcast, I love having him on, and hopefully he will not forget about us, and he won't. He's a good friend and a great guy, a great analyst. But again, that's how I feel, and I always say this, and I mean it. So let me know what you thought of FrankCurzioResearch.com. So this podcast is about you; it's not about me. And again, I could get on numerous guests now, thanks to you. The podcast continues to grow. So keep sending me ideas. I know I probably received more than a dozen emails from people saying, hey, Frank, I would love to hear from this guy or that guy. No self-help gurus or anything like that. That doesn't work with our audience. I mean, I think people know that they shouldn't have a lot of debt. And, I don't know how many millions and millions of books can be written about this, but mostly stock analysts, economists, world leaders. I mean, we've been interviewing billionaires. I mean, if you think there's someone that would be a fantastic guest, let me know. I definitely have them on, and the exposure's that big where, thanks to you guys, and, I'm always humbled in saying that, where, they'll come on. They'll get a lot of exposure because we have a lot of listeners. So, just let me know, frankcurzioresearch.com. Now, let's get to my educational segment. So a few weeks ago, nice guy, nice investor, and listener, Brandon, asked me a question. And he goes, hey, Frank, I own Anadarko, which Chevron just made a bid for at $65. My target was $61.50, so I'm up 50% plus in 18 months. I also heard that Oxy made a $70 bid that was rejected. Now, guys, keep in mind, this was April 14th, right? We kind of know, a lot of you know what happened now. Going to get to that in a second. So he goes, it continues, he goes, I also heard that Oxy made a bid for $70 rejected. Is there a general rule you have or that you've learned through all your experience on timing and how these bids generally work out? Is it best to sell right away when a bid is made or hang in there till the end or close to the end in case there's a bidding war or just because it makes sense financially? Thanks for all you do. Special thanks to you and your family. That allows you to be shared with us. And Brandon's a good guy. And it was a great question. So the offer for Anadarko was from Chevron, right? One of the largest oil companies in the world, industry leader, $33 billion. And then Oxy came in, Occidental Petroleum, raised its bid to around $38 billion. Oxy has a $44 billion market cap, right? $3 billion in cash on its balance sheet, free cash flow $1.5 billion. And if Oxy wins this bid, it's going to have to sell 10 to 50 billion in assets right away to cover it, right? So think $44 billion market cap. Chevron has a $225 billion market cap, $9 billion cash compared to $3 billion with Oxy. Free cash flow $13 billion compared to $1.5 billion for Oxy. So when I got this question, my advice, look, you have two bids on the table. You're looking maybe 5-7% upside from here if they accept the Oxy offer. But if the bid falls through and both of these companies, which, you have two reputable companies bidding for this. So, the chances of that are going to happen, I told them, were little. But if they do pull their bids, then the stock is going to fall, 25% plus or whatever the premium was. That usually happens if a company rejects that offer. The bigger thing was the opportunity cost, I told them, because sometimes these deals could take 6 months. They could take a year and a half to get done. And you have your money tied up looking for maybe a little bit of a premium from the Oxy bid. And that's money you could put into the markets and buy some of your favorite situations. So for me, I was like, you made a good return. It might probably be better if you sell, take the profits and go in. And I give that advice over and over again because I've been through this process dozens and dozens of times through my 25 years plus research experience, right? I've owned and even recommended a lot of companies in my portfolios that were acquired for big premiums. So for me, this is the right advice. This is good, right? Yeah, you're looking for a little bit more return. Don't get too greedy. You're at 50% plus and move on. And you know what happened. If you don't know what happened, I'll tell you, because I was a little bit wrong, right? So I was wrong because Oxy and Anadarko, they actually accepted Oxy's bid over Chevron, which means, that stock's trading higher. And it also helped that Warren Buffett came in with $10 billion of financing for Occidental that it said will only provide if this deal actually goes through. It's official. And Berkshire's terms are incredible. And you got to love Buffett for this. So basically, Berkshire is going to purchase 100,000 preferred shares of stock, which pay an 8% yield, which is awesome. And if this deal falls through, Berkshire is going to get paid anyway. I think it's something around $50 million or some $50 million. Don't quote me on that if the deal doesn't go through. And, its stock fell on this news because of these crazy terms, because they're going to have to do so much to actually compete, to really get this thing done. Now, the lesson here, which again, you're not going to read or hear about anywhere else. People say history repeats itself, or at least it rhymes. But not all the time. This deal for Anadarko, the way it's going down, almost never, ever, ever happens where a mid-tier company outbids an industry leader, especially when it comes to a deal this size, which is really over $50 billion in total when including debt. But if you read investment books and you're a new investor, you're going to read all these books and you hear the same things over and over again. Don't put all your eggs in one basket. Stay diversified. Most billionaires put all the eggs in one basket. They're not diversified. They're all into their own company. Would I give you broad advice like that? Of course. But if you're young and you have a good idea and you have plenty of working power, if you're wrong, to do lots of different things, but that's when you make the biggest impact. But you're not allowed to say that, right? As a person giving advice, well, diversify, get into international stocks, have a little bit of exposure here. I'm glad guys like Zuckerberg, Jeff Bezos didn't listen to that advice. Elon Musk, whatever you think of him, I'm glad. You should buy stocks with low PE ratios, right? They tend to outperform the market. That was from database from the 50s to the 90s, even to the 2000s. It showed plenty of studies. A lot of famed value investors wrote about it. It's great. Let me tell you something. Apple was trading at 65 times earnings in 2004. Netflix was trading at 75 times earnings at the same time frame. On a split-adjusted basis, Apple was trading around $6 back then at a 65 times PE. If you're a value investor, you're like, I'm not touching this thing. Well, it's too bad. Because that's 30x gains you could have generated, right? If you avoid the advice of what value investors are telling you. Netflix was trading at $3 in 2004 on a split-adjusted basis. That's a 120x gains. Think about that. That's enough money to change your life. And that's over 15 years. It's not that long. Imagine owning that stock and keeping it to today. I mean, you talk about probably having a helicopter, 4 houses, a nice beachfront, pretty good living on a stock that how many people told you back then, man, this is crazy. This is too expensive. Don't buy it. Same thing said with Amazon, Microsoft. These companies were really not expensive in 2004 when you factor in both sides of the story. The other side of the story is growth potential. It's like our massive debt problem in America, right? I mean, you can go anywhere. Everybody knows about it. It's cited everywhere. Politicians fight about it. 21 billion plus in debt. It's a scary number. It is a scary number. I can keep going. What is it? 1.3 trillion now in student loan debt, over $1 trillion in auto loan debt. Yeah, subprime, all this stuff. You're going to hear all these stories. It's just one side of the balance sheet, right? Nobody really talks about the other side where net household wealth is near record levels. Look at homeowners have more equity within their homes than any other time in history. And what, close to 70% of Americans own a home? I bet over 85%, 90% own other assets like stocks in their 401ks. Look where stocks are. Collectibles, you're looking at art, anything. Rare stuff. I mean, all of this, these assets have been inflated tremendously because of the Fed, which we know, right? Lowering interest rates, forcing more money to come into these markets. And nearly every asset is surged since a credit crisis. But nobody wants to talk about that. Nobody. They just want to talk about debt because debt is a much more exciting story. Holy cow, you're going to lose your money. You're going to get killed. ATM's going to stop giving you money and printing money. And you got to take it all out and put it in a box and bury it in your backyard. Open up international accounts. All this garbage, right? For 10 freaking years we've been hearing about. Again, nobody says both sides of the story. Nobody tells you that. Because most people have an agenda. Another thing I love to hear is, taking out debt is terrible, especially corporate debt, right? Because corporate debt is surging. Guys, debt is a great thing if managed correctly. And think about it. How would anyone, probably 95% of people living in the U.S., how would they be able to buy a house without being able to take out a mortgage? You're going back to corporations. You can now borrow record low interest rates, or close to them today, a little bit higher. It's going to help them grow their companies even faster. Again, doing the right thing. I mean, rates are so low. August 2016, Microsoft sold $14 billion in bonds to the market. In 2017, sold another $17 billion, which was increased from $14 billion due to insane demand. Deal was rated AAA from Moody's. If you look at Microsoft, their balance sheet is amazing. It was over $100 billion in cash before this deal. You can say some of it's overseas and this is a little bit better, and whatever it is. You look at the biggest companies in the world raising money in the debt markets, even though they have strong balance sheets, because capital is very, very cheap right now. It's a smart thing to do if you do it properly. It's a great thing. If the cost is favorable, which it is right now, and you manage this money in the right way, or you're not leveraging it 30-1 like so many companies did, which basically caused a credit crisis. My point here is you have to be open to learning new strategies, new ideas, because in this crazy industry, which I love so much, things are never the same. You have to be willing to adapt. That's why I love my job so much. It's like golf. No matter how good you get at it, you can never perfect it. There's always room to get better. Always room to learn. Always room to improve your game. So when it comes to the markets, check your ego out the door. I see this with so many great hedge fund managers, so many great money managers out there. Usually they're over 55, but they're set in their ways. Don't be stubborn in your ways. Don't be like a David Einhorn who refuses to invest in growth companies, and that's why his fund's gotten crushed over the past 5 years, where you're seeing a lot of other guys getting, usually pure value guys, getting into the Amazons of the world and getting the net. I mean, you're looking at Buffett buying Amazon right now, saying it's a value play, right? Recently, his managers are buying Amazon now. I love that about Buffett. I wouldn't agree it's a value play right now. I mean, we invested in this thing, and I recommended it in my Curzio Research Advisory newsletter at under 1,000. People up pretty much over 100% on this position. And people didn't like that I recommended it because that's not what they pay me for. But when I researched every single cloud company and really dug in, Amazon was the greatest ever. And I saw a chance for my subscribers to get gains, and they did. But be willing to change, guys. Be willing to learn. Be willing to adapt. I was fortunate. I'm a good example of this, when my dad was a pure value investor. And then when I went to Kramer, I didn't know anything about growth. And it was like a huge, like that learning curve of 5 years, coming to so many growth companies. I was fortunate to get thrown into two different styles of investors from two great teachers. That helped me tremendously. And even now, I mean, even, you look at technicals, I interview so many great people, and I'm always interested in their methodology investing, which I try to get across to you. And I learn it and see if I can use any of it and use it with what I'm doing. That leads to tons of ideas for me. Because it's funny, because I was talking to a really great analyst. He's like, Frank, well, you know what? You're a growth guy. I'm like, I'm not a growth guy. I would say actually I'm more a value guy, but I'm investing in growth over the past 7 years because that's what the market's telling me to do. Don't fight it. Don't get emotional about, oh, the debt and banks are assholes and all this stuff and look at all that debt. You have to realize the Fed has great policy in place. Money is easy right now, which is very, very important. You've seen balance sheets flush with cash. Dividends are rising. They're buying back stock. Earnings are very strong. There's a lot of positives in the market. So pull your emotions away and always be able to adapt to different market conditions. It's not easy. It provides you learning something. It's like you becoming golf's a great example. I mean, they're continuing trying to develop a better swing to just, sometimes that, with Jordan Spieth, that went on to be a disaster to win all the majors and stuff like that. Now the guy can't even make a cut. But you want to be willing to adapt to all kinds of market conditions. And the only way to do it is check your ego at the door. Again, this is something you're not going to read in investment books. It's not going to be mentioned anywhere because you can't really write a book about it, right? So I'm basically saying everything you learn about stocks today may be totally different tomorrow, right? It's hard to write something like that. And look at IPOs. Look at that industry, guys. I remember IPOs used to come out with good companies. Now it's so much more favorable if you're not generating earnings. I mean, these guys are saying, well, we're not going to be profitable forever, like Lyft. Yeah, that's the trend. Don't, you could go on social media and complain and whatever. That's fine. But smart investors adapt. They go with the flow. You know what? That's how you establish a 20-year plus career in this business, because you get it right more times than wrong because you're willing to learn from your mistakes, because history does not always repeat itself, guys. It doesn't. This deal with Anadarko, stuff like this never happens. I mean, you talk about Chevron and a mid-tier, and the mid-tier's outbidding and getting Buffett and going to have to sell their assets, whatever. And Anadarko really doesn't want to go with Oxy, but for the shareholders, it makes sense, and that's supposed to be their best interest. But in reality, Chevron's a perfect fit. It's like IBM and Red Hat, because when you merge with a company, it's not a perfect fit. It's not fun. It's tough. That integration is going to be really, really difficult. So as a business, long term, I think I would be selling Occidental. I think this is a terrible decision. I think they're paying way too much. They're giving Buffett free money to get into this just to put his name on it. So, they'll be able to get this asset, which Buffett doesn't care about. He's going to get 8% on the deal anyway, and probably make a fortune on his freaking shares. That's fine. I don't know if I'll make a fortune on his shares. I think he'll lose money on those shares eventually. But just always be aware that it's not always the same. Even from a guy that's been doing this for over 2 decades, it's not always the same. Things change. And when they do, be willing to adapt. Whew. Wow. Crazy podcast today, right? A little bit long. A lot of good information, a lot of good ideas, great interview. And that's it for me. I don't think I can give any more today. But one thing before you go. When it comes to tariffs, I created a 20-page plus report that I sent out last year, and I updated it. It's on our website now, www.curzioresearch.com, absolutely for free. Some of you may have read it already, but it is updated now. If you're a subscriber to the services, you probably definitely got it. But I really break down this tariffs thing in a way you're not going to see anywhere else. What it truly means, why the U.S. is getting screwed, why China has to sign a deal with us or risk at least depression. And more important, I'm going to break down the numbers showing you why a 25% hike in tariffs is not really that big of a deal for us, at least, right now, considering how much money companies are generating from tax reforms. So when you actually see the data, you're going to realize how pretty much 99% of the stories you're reading about tariffs is complete nonsense. It's really good. It's aggressive. It's challenging, but it's real. And it's something you're not going to read anyplace else. And I wanted to put that on our website, curzioresearch.com. It's absolutely for free if you want it. Just go there. If not, no worries. It's perfectly fine. So, guys, thanks so much for listening. Hope you enjoyed the playoffs. Man, Petrides knew a lot about basketball. I was pretty impressed. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.